Hello, this is Mike Swanson of Wall Street Window, and I got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website marketviews.tv, and he's prepared a very comprehensive report on what's going on in the gold market with a very unique indicator that really has got my attention. How you doing today, Ike?
I'm doing well, Mike. My pleasure to be your guest.
Yeah, well, it's fascinating stuff, and maybe we should just get right down to it. I'm pretty sure most of my listeners are familiar with your work from previous interviews that we have done in the past.
Well, Mike, our aim is to provide people with insights that probably they cannot get from some other place. Because if they can get it from other places, why the hell should they listen to us, right? So I am going to present a few charts today that I don't believe people have seen or they will be able to see some other place. The first chart comes from a couple of friends of mine who specialize in gold trading and are based in London. Now this chart is a monthly chart and is based on a monthly survey that they run. It's an email survey. They send the email and then they collect the answers. And the email has two components. The first component is if you're bullish, bearish, or neutral on gold. And if you're bullish, then if you're bullish, neutral, or bearish, then the next component is, once you have answered that, then the next answer is that on a speculative basis, on a event risk basis, like you're buying, gold because you want to have assurance in case something happens, or you're buying it in terms of store of value with an outlook of about 2 to 3 years. All right. If you look at this chart, you can see that now the red line is the speculators. The blue line represents the percentage of respondents who were buying gold for insurance against an event risk. And the green line is the percentage of respondents who were buying gold for store of value purposes, and they had an outlook about 2 to 3 years and beyond. What is interesting is that you looked at in 2008 and 2009, as gold went down, people who were interested in gold on a longer term basis, 2 to 3 years and beyond, their percentage went up. In fact, it was the highest level around mid-2009. The people who were buying gold or were interested in gold because they wanted some insurance against event risk, you can see that the percentage soared from 2008 until 2009. That is expectable. That is expected because 2008, 2009, early 2009, we had lots of turmoil. Okay.
Yeah.
And the headlines had to do about the world coming to an end as we knew it.
Right.
It is expected people interest to have gold as insurance would rise. Now the red line is the people who were buying gold or were interested in gold as a speculative vehicle. And we can see that as gold rose from its bottom in 2008 until about late 2010, the interest was flat. It came under the radars once gold accelerated its rise, which is usual because when something accelerates its rise, then that is when it gets more speculators. Correct?
They're kind of chasing the price up and down almost, or not really, because this year gold's not really, it's not falling, gold is up, but their interest is going down anyway.
Well, you can, and then what is happening is you can see that their interest, went up all the way until 2015. What's happening is that you have people, between 2013 and 2015 trying to pick the bottom.
Right.
And then as the bottom never realized, they lost interest. So from 2015 until now, or flat, gold has been, you can say flat. I mean, right now it's close to what it was back in 2015. The interest has gone way down.
Well, what's the difference between someone that's looking at event risk and someone looking 2 or 3 years out?
I really cannot define that in clear terms. But I can tell you this. I think event risk, going back to old school, I know from many people who I interviewed who were brought up in the business in the 50s and the 60s, they always thought that you had to have between 5 to 10% of your portfolio in gold in case something happens. My good friend Art Crawford says something that's kind of funny. He summarizes that saying you have to have some gold to bribe the guards at the border. Okay, it's a funny way to summarize it. But I mean, that kind of reflects this school of thought that something could happen and you have to have some insurance. That insurance has to be somewhere between 5 to 10, maybe 15%. Okay? This school of thought, has lost ground over the last 30 years. And it has lost more ground actually over the last 10 years. Because just when the world seemed to come to an end in 2008, it didn't. So it is natural that this this school of thought and this group will lose interest. Okay, we can see we had two glimpses to the upside. One was in 2015, and the other one is now. Both have to do with, I believe, the stock market falling and the news coming up with several disaster scenarios. Okay. So that kind of rekindle people's interest in owning some gold for insurance. But what has my attention out of this chart, out of this data, is that the people whose outlook was longer term, they were right buying gold near the bottom in 2008 and 2009. Something that is even more important to me, more interesting to me, I should say, is that my friends collect a lot of demographic data, and I can tell you that the median income and the median net worth of this group, from the sample that my friends get their responses, is 6.3 million.
Oh wow, that's interesting.
And the average age is 61 years old.
Okay.
So you have people who have accumulated wealth. They have accumulated perhaps some wisdom by investing, I don't know how many years, 20, 30, 40, okay? Now, somebody will say, well, that's a smart money. Actually, the interpretation is a little different. And that is, if you're worth 6.3 million, okay, most likely you don't worry about how to pay your mortgage or your car payment. More than likely you don't have a car payment, you just have a mortgage. Okay? That means you can afford to wait. You can afford to be patient, I should say. Your investments, your trades don't have to pay up tomorrow so you can become wealthy. You are already wealthy.
Well, you don't need to be reckless or gamble to try to make a killing or something either.
Yeah, exactly. Okay. So, in the past, like I said, this group of people has been correct. Actually, it has to be seen if it's going to be correct again. But the point I want to highlight is people who have an outlook beyond 2 and 3 years, and they have an Indian net worth of about 6.3 million. For the last 6 months, they have been accumulating gold. To me, that's interesting because it hasn't happened since 2008 and 2009. The next chart, which actually seems to confirm the above, is this. It's the share of world GDP for India, China, Middle East, West Europe, and USA, going back to 1 AC. Now we can see that for almost 1800 years, China's shares of world GDP was somewhere between 22 and 35%. The exception has been for 150 years, from about 1820 until 1973, where its share of world GDP went down. Since 1973, China's share of world GDP has been rising, and it looks like if we go back to the historical norms, and given that China's population does make almost 1/3 of the world population, China's would have 1/3 of the world GDP. The important thing to get out of it is this, in my view. If you look at world history, the country that had the most military and economic power was also the country whose currency was the world reserve currency at the time. Going back to the 400 and 500 BC, the Athenians were the world's superpower. The world's currency at the time was the drachma. Then the Romans became the world's superpower, and the world's currency became the denarium with the sestertium. And then after that, we had the Byzantine Empire. The world's currency at the time was the Byzantine gold solidas. We go forward and we see the emergence of Venice, and then the gold ducat of Venice became a world currency in the Mediterranean, right? We go 100 years later, Florence of Italy becomes a military and commercial power. And what do we see? We see the emergence of the florin of Florence. Going forward, we have the British Empire, and then the world's reserve currency becomes what? The British pound. The United States comes after the British Empire. The United States, until now, has been the world's truly biggest economic and military superpower. Therefore, it's not surprising to see that the dollar has been the world's reserve currency. However, if the trends that we see continue, it means that whether we like it or not, we're going to have to share this economic and military power with China.
Well,
meaning the dollar going forward is not going to be the only world's reserve currency. So going forward, not necessarily next month or the next 6 months, but if you look at it over a 2 or 3 year basis, I think the dollar is going to depreciate further. Something that could pressure things in the meantime is the perception of higher deficits. it should be noted that although we have had good economic growth and higher interest rates, that has not helped the dollar. Neither one of them. The question is why? Because the perception, or the focus, I should say, of the investor is not on economic growth or the higher interest rates, but it is on the potential of much higher deficits. The potential higher deficit is what is putting pressure on the dollar right now. If you look at the way the dollar is behaving, it seems to me that from a shorter point of view, we could get a pop. But from a longer point of view, meaning 1, 2, 3 years out, the dollar will come under additional pressure. And that ought to help gold.
Well, I almost, I don't know how I'm classified in these categories, but that you showed in the first chart. But I just note that, I own gold. I think I'm doing it for a couple years out. But I also am fearful that the bond market is in a bear market, that and the dollar's declining, and that might make gold a necessity for people to own, to be diversified.
But it could very well be, if we move on to part 1 of this report, and we start out with part 2 because that is as of today.
Okay.
Part 1 was posted for my subscribers on April 9th, which was 10 days ago. So part 2 comes on top of it. So if you move down to the part 1, you will remember that throughout 2017, especially actually the last part of 2017, I had stated that if we're going to get a substantial rally in gold, in the near-term rally in gold, that should happen around mid to late December. Okay, we did get that. One thing, though, that kind of kept me off balance was that the time frame came right on time, but some of the intermediate to longer term indicators that follow did not show at that time the policy divergences or the readings that usually are associated with multi-month bottoms. So my view was we will get a rally, but I was pretty cautious about it. As it turned out, okay, and this is, gold rallied until about mid-January, and since mid-January has pretty much stayed in a trading range. Gold stocks rallied and then went right back to the lows in December. One thing about gold stocks, and I want to give credit to my good friend and frequent guest, Mr. Eric Haddig, is this. Eric Haddig has pointed out several times that gold stocks have two components. They have the gold component and they have the stock component. Sometimes the gold stocks act under the pressure of gold and sometimes under the pressure of the stock component. And his point has been that the decline that we saw in gold stocks had to do with the stock component of the gold stocks acting in tandem with equities, which plunged in February.
Okay.
But nevertheless, if you look at gold, is near the top of its range. If you look at gold stocks, they're near probably the middle of the range. Okay. So over the next few weeks, the outlook may be murky. But again, if you look a little bit further on that, and you look at things that traditionally have helped gold, like inflation. people who have been in the business for longer than 30 years, they can recall that although at times when inflation goes up, rates may go up, and normally rates are not good for gold, but inflation is supported. And when investors focus on inflation more than interest rates, gold is the beneficiary. My good friend Jim Ross, since December, has pointed out the inflationary pressures that were building and that will become evident during the first quarter of 2008. And I don't want to take too much time. People can read, the report. But so far, it seems that the inflation expectations are actually behind what is really happening. And I think going into the second half of the year, I don't believe that inflation is going to be excessive, but I do think it's going to be a little higher than what people are expecting. And that ought to help gold prices as well. Now, the next chart is the US dollar. We showed that chart in another interview that we did in mid-January.
Right.
And my point was that, look, this chart goes back to 1980, all right? And what we can see here is that out of 459 months, okay, there have been only 17 months from September of 92 until January of 94 that US dollar and gold moved in the same direction. The rest of the time they moved in opposite directions. So, not because I say it, because the chart says it, gold and the US dollar since 1980 have had a negative correlation 96% of the time. So, that tells me from a risk reward point of view, alright, if the dollar is going up, more than likely I'm cautious on gold, and vice versa. So, if you look at the next three charts, which is the daily chart of the US dollar, the weekly chart,
monthly,
and the monthly, okay, it looks to me that the dollar is very close to making an oversold bounce. But longer term, the dollar is in trouble. So any rally from here will negatively impact gold, but I just don't see the dollar going above 95, 96. Okay? So, in my view, a rally in the dollar, if it happens over the next few months, and a subsequent decline in gold, it will be a buying opportunity for gold.
Okay.
Because longer term, I think the dollar is in trouble, inflation is going higher. And the next chart, which is shorter term, that is UUP. It is the ETF for gold. Okay, we can see that above 2375.
Or the ETF for the dollar.
Yeah. Above 2375, it can rally all the way up to 2475, maybe 25. I said over the next 1 or 2 months, the outlook is kind of murky, okay? Because we have lots of cross currents. But if you're looking at 1 or 2 or 3 years, I'm more convinced than ever than I have been the last 5 or 10 years that gold is going to be higher than where it's at now, okay? The next chart it is gold for, and it's the daily chart, the weekly chart, and the monthly chart. Now, I want to focus a little bit on the daily chart because what you can see is that gold is actually near the middle of this channel. This chart was on, I had it from April 6th. I will speak right now is about near 1360. So it's still in the middle of the channel, meaning it can go either way. A break above 1375 will probably drive gold to about 1410, maybe 1450. And on the downside, we have support around 1250. For me, if dollar pop and gold decline to 475, 450, that would be a great buying opportunity. The next two charts that we have, again, is gold on a daily basis and a weekly basis. It's trading near the top of its range. One thing that I have learned about charts and price behavior is that when something is testing and retesting a level, eventually it breaks it. So with gold testing and retesting resistance between 1360 and 1375, I have to conclude that more than likely it's going to break it. Something that also I want to get people's attention to is the second of the next two charts, which is GVZ, is the volatility index for gold. Now the interesting thing is, usually volatility picks up in equities when they drop. The opposite holds true for gold. Look at the volatility index for gold. You'll see that it topped very near to the top in early 2015. And again, the same thing in 2016. Notice how volatility topped every time gold popped to the upside, which is exactly the opposite than what has happened with equities. Okay? Now, if you look at the behavior since early January, we had the popping volatility as gold tested the top of the range in early 2018 in January, and since then has been in a tight range and volatility has dropped. A dropping volatility, as we can see from this chart, usually means high gold prices, at least in the short term. Okay, and again, the point I want people to get out of this is that opposite to equities, gold and the gold volatility index trade differently. You get spikes up in volatility in equities when volatility goes down. The opposite happens with gold. Now, if you look at the Huey, the Huey's and gold stocks, okay, Huey, XAU, and their ETFs, TDX, they are pretty much in a neutral range. Back on April 9th, I had pointed out that the XAU had formed an inverse flag. The important thing about it was that if you look at the XAU gold race, XAU GLD race, actually it was forming a bottom. When the rate forms a bottom, usually the negative aspects of price do not materialize. Okay. And actually this is what happened. We got a pop to the upside.
Right.
Okay. So, all in all, if you look at gold, at gold stocks, okay, right at this point, they could fall victim if there was a further drop in the stock market. Okay, and we saw how they dropped in February. The thing to remember is that once the gold component of gold stocks takes over, then gold stocks could run substantially. For that to happen, we will need a break to the upside in gold. So I would caution that in the short term, if we would get a further drop in the equity markets and a pump in the dollar, those stocks could be affected quite a bit. But at the same time, I also see this as an opportunity to buy stocks that are behaving well. The last part of this report that I want to focus is this. If you look at the gold stock universe, there are stocks that have done well, no matter what gold stocks altogether have done. And I have listed 32 stocks, 30 gold stocks.
Oh, wow. Yeah.
Okay. Now, my suggestion is, okay, if you want to be long gold stocks, okay, then why not concentrate on those gold stocks that have had the highest relative strength and they have been doing well, no matter what gold stocks in general all the equity markets have done or gold has done, okay? One of them is BVN, all right? Buenaventura.
Yeah, I own that actually. I just say that so people know, that's all.
Now, there are other stocks, okay? You can look at the FCX, Freeport McMoran, okay? Now, you can, there's another stock which is a special situation, and that is Eldorado Gold. Now, Eldorado Gold has collapsed due to its problems with its gold mining rigs. They had to write off over $1 billion in investment. Now, unless the company is going bankrupt, the current price has discounted fully the situation in Greece. So, if you want to speculate in something, Eldorado Gold may be a good candidate. You can look more into it. FCX, Freeport, okay? If it breaks below 16, then you can, and more probably below 14, that would be negative. But right now it's in the middle of its range, which means it has an upside potential about 22-24. If you look at common charts, we have like Iron Gold, Kinross, Pan American Silver, Rand Gold. We also have two charts that have triangle formations like SSR mining and Wheaton precious metals. Okay, so my point is, and I encourage people to take a look at these 32 stocks. Take a look at the charts that have the highest relative strength, and based upon the support and resistance levels that I have listed, you can take a position. You can take a position if it breaks above resistance. You can take a position and have a stop at right below support. Nevertheless, my point is, I believe that if you have a little longer outlook, a little in terms of time, you have a bullish outlook for gold, I happen to believe that the bigger opportunity is in select gold stocks than in buying GDX or GDXJ.
Yeah, one thing I want to add about what you just said is that if you look at GDX and these stocks that you're on here, many of the stocks, and BVN is one, but many of them are outperforming GDX substantially. And I just want to point out to people that one of the reasons why that's happening is that almost 9% of GDX is in one stock, which is Barrick. And Barrick is one of the worst performing of the stocks you have on this page. And it's dragging down the performance of that ETF. And unfortunately, ETFs, I mean, the good thing about ETFs, it's easy to press the button and put money in it and not have to think, well, what does it own? Or it's just, I'm diversified. However, a lot of times it's a little bit of an illusion. The XLF ETF is one of the most popular ETFs, but a third of that ETF is in just like 3 stocks. And there's many ETFs that they only have 1 or 2 stocks and half the money is in it. And GDX, almost 10%, is in an underperforming stock. So that's something people need to, the ETFs are so easy to throw lots of money at, but in the long run, I've actually come to the conclusion that you're better off in individual stocks.
Well, if you own, for example, RGLD, Royal Gold.
And I own it. I just know
that. Or Kirkland Lake Gold, KL, all right, or even Newmont Mining, for this matter, all right, NEM. You even know that GDX just a couple of weeks ago was back to its lows from December. So, I mean, there is a time to buy ETFs and there's a time to focus on components. And I just think that if you're bullish on gold longer term, perhaps you will get more for your buck by focusing on some individual gold mining stocks rather than GDX or GDXJ.
Well, the other thing too is that the ETF charges you an annual management fee of around 0.5%, and it only pays about 0.25% of a dividend. And if you buy, Royal Gold or some of these others, you're going to get a dividend of 1% or more, and you don't pay, a 0.5% management fee. So that's something that doesn't sound like it makes a difference if you're holding something for, or planning to for a couple of years.
Yeah, I agree. So anyway, I hope, we had the opportunity to show the people a few things that they can see someplace else and benefit from it.
Oh, definitely. No, thanks for taking the time. I mean, I know you've been here for almost 40 minutes. I don't want to keep you any longer. I just want to say thank you for doing this and showing people the first couple charts in particular, things I'd never seen before. Really fascinating. But I think people should know too. We've doing these interviews for years, and this is actually one of the most bullish reports you've given on gold in a very long time, in years, really.
Yeah, and I encourage people. On the top of the page, I have listed the address so people can read the entire report and can see my comments on each and every one of those 32 gold. So, I encourage people to read the entire thing. It will take them some time, but I think it's worth reading.
Oh, definitely. Well, thank you, and we'll do a follow. We plan on doing another follow-up in 1 or 2 weeks, just about.
Yeah, and I promise that we're going to show some other very unique charts when we do that report, and it would have to do with equities.
Okay,
and
great.
Charts that also people have never seen before.
Oh, awesome. Well, thank you, and we'll talk again later.